Hello everyone. Today we would look at a mutual fund Fidelity Natural Gas Portfolio, ticker symbol FSNGX. I couldn't find much analysis on this mutual fund on YouTube, so I decided to share my own analysis with you. Today I would be covering the overview of FSNGX, its key stock holdings, and how those holdings are doing. We will be able to decide if these are worth investing in. Since the FSNGX mutual fund invests in a diversified bucket of these stocks, we can decide if FSNGX itself makes sense for us. In the video, I would also be covering the effect of natural gas prices on FSNGX mutual fund as well. Finally, I would share the technical analysis of the mutual fund to formulate my strategy. Disclaimer: in no shape or form this video is my financial advice to anyone. The purpose of this video is to share my analysis with you for education and learning purpose. So let's get started.
Fidelity Select Natural Gas Portfolio. The key statistics of the fund are one, expense ratio is 0.89%, which is pretty high for a small focused portfolio. There's not much the fund manager has to do except buy some of the big names in this industry and just keep it there. So this expense ratio is a little bit too high. In terms of portfolio net assets, $170 million. If you look at the last 10-year charts, this magenta line is the FSNGX. So overall performance over last 10 years is pretty bad, which is $10,000 invested will become $7,700 versus if you compare it to natural gas. This orange line, this is $11,902. So this is like a massive underperformance as compared to its own sector, and this high expense ratio definitely is contributing to that underperformance compared to S&P. S&P, this is like really underperforming asset class by itself. So overall, I think a pretty bad, dismal picture for the entire mutual fund. So you might ask, like, why, with all the negatives, why will someone in the sane mind purchase a mutual fund like this? The answer will be two reasons. One is people who invest with contrarian strategy. They can see, like, for 10 years this has been underperforming, so eventually next 10 years they will hope for outperformance, or at least reversion to the mean, giving better returns than what they have seen in the last 10 years. And why this mutual fund with such a high expense ratio? The answer will be mostly because of ease of purchase with Fidelity. If you are looking for dollar cost averaging and setting up some purchases and occasionally selling them based on alerts when the prices shoot up like 20-25% in a year, so those will be the reasons you'll be purchasing this mutual fund. Looking at the top 10 holdings of the portfolio, they make up more than 50% of the total portfolio size. These include some of the big names in natural gas industry, and overall the mutual fund has only 60 holdings. So overall it's a very focused, concentrated portfolio. Any fluctuation in any of the stocks can have a big impact on the overall portfolio. Now looking at the individual holdings, first one is the EOG. EOG Resources is involved in the exploration, development, and production in the oil and natural gas market. If you look at the 1 year performance, it has been all reds. It has been falling. So starting with October, November last year, there was a big steep decline till the end of the year. And then end of the year or January, the stock saw some rally, went up, came down, went up and came down. So it has been bouncing around mostly in a downward trend. Looking at the analyst recommendations, it's really bearish. At a scale of 1 to 10, it's being rated as 2.2, which is quite bearish in nature. And earnings wise, the company has been doing fairly well. So they missed earnings in Q4 last year. That's when the stock declined quite a bit, but in Q1 then they beat the estimates, and Q2 again they missed the estimates, but not by a large margin. Dividend yield wise, they are giving 1.5% yield. So overall, looking at the earnings, PE ratio is pretty good, 12.19. It is slightly higher than the industry, but for good quality stocks, we will expect to pay slightly higher PE. For last 5 years, PE was bad, and EPS growth, earnings per growth has been negative. But forward-looking things look pretty decent in terms of financial numbers they have. And if you compare them to rest of the industry, in oil gas industry, most of the stocks have a pretty bearish outlook from the analysts, and the price performance over the year has been pretty negative for the stock as well as for other major stocks in this industry. Industry average is 12% negative, but overall EOG has underperformed. And the beta for the stock is 1.17, which is showing it's more volatile than the market. The fifth and last stock which I am going to analyze is Schlumberger. Schlumberger again has similar trend: fall, rise, fall again, and the trend is very bearish for this stock as well. On the positive side, they have consistently met the earnings, including Q4 last year. So in terms of earnings stability, the analysts should be pretty happy with this stock. They have a positive PE of 21, and the company has proven itself that it's managing pretty well the resources it has. One of the positives is they are giving very high 6.1% yield, which makes it risky in the sense dividend oriented investors, they might think that if the 6.1% is sustainable, everybody will, as an investor, will hope that the stock rises to adjust the dividend yield portion of it. But if they don't and industry remains in stagnation, then management might turn some of these dividend to the bottom line and bring it out of investors' pocket to the bottom line of the company. If you compare it to the other stocks in the industry, they compare to Halliburton, National Oil Well, and Ensco, VAL. For all the other stocks which are comparable, everywhere the analyst ratings are pretty negative and poor. If you look at VAL, it had a price drop of 82% over the year, with the stock analyst rating of 0.8, which is very bearish in the nature. Despite the earnings stability, Schlumberger saw higher volatility with beta of 1.27. Right. And next one is the Noble Energy. Now, Noble Energy is also involved in development, exploration of crude oil and natural gas related businesses. One of the things you will see is analysts are very, very bearish on this stock. And the reason for that is their operating sheets are not looking very good. The company has a lot of long-term debt, and their operating money is not able to pay up for some of those debts. So there is a concern that company could go bankrupt. The company is paying 2.23% dividend, which yield, which is fairly good for making some of the investors to stick around to see if the company can turn around. In terms of beta, it's 1.43, which is higher volatile than the industry. If you look at the earnings, this is one of the stocks in top 5 for the sector where you're seeing negative earnings. There were 2 quarters back to back where they missed the earnings. Finally, they are starting to turn things a little bit around, but not as good. They had a small earnings beat in Q2 this year. Overall, because the company is running in losses, the financials are not good, and that's what is the reason for very bearish recommendation for the analysts. In terms of the stock performance, again, starting from last year, they show a steep decline, just like all other rest of the industry. Then rise till April-May timeframe, and then fall for the summer. One of the differences for Noble Energy is the stock, probably a lot of the bad news about the financials has been baked into the price, and we are seeing a little bit more stability in this stock in terms of finding the bottom. and this bottom is higher than the last bottom we saw back in December, which is like kind of creating a positive trend for this particular stock. Once this consolidation resolves, that will pretty much set the direction for the stock, whether it goes up or down. That is to be seen in near future. Next in the line is Devon Energy. Devon Energy stock-wise, again, same trend, falling pretty hard till the end of 2018, and then having a sharp rise till April during the winter and season, and then summer the stock is again falling. In terms of stock recommendation from analysts, it's on the neutral side, 4, which is again one of the better ones. In terms of earnings, they had a pretty good 2 last quarters where they had back-to-back earning beats. PE is looking pretty good, 8, which is better than the industry, so I'll call it a value play. In terms of dividend, it's a little bit lower, 1.6%, but overall pretty decent profile for the company. So if you compare them to Devon, the similar stocks in the industry are Apache, Chesapeake, Conoco Resources, and ConocoPhillips. So all these stocks, they have pretty bad analyst ratings and performance for rest of the years. For the Devon Energy, beta is pretty high. That means the stock is more volatile than stock market, and reason to buy this stock is mostly because of their good fundamentals in the PE ratios and such. Next is the Williams Company. This is the infrastructure play for natural gas. The beta for this stock is 0.93, and overall analyst recommendation is 5, which is one of the better ones than other stocks in this industry. Williams Company compares to other stocks such as OneOK, Cherny, and Targa and Talgrass. As you see, like all across the sector, the analysis ratings are pretty negative for the entire sector, except 1 or 2 good spots. Price performance for 52 weeks has been pretty dismal all across the board as well. Again, there are few glimmers of hope across the industry. Let's look at some of the price action charts, support and resistance for major 5 stocks in this industry. Devon Energy, it had a crossover for support and resistance. The bearish trend has been continuing. The stock tried to form a diamond pattern in August, which was broken down, and since then the stock has been taking this negative trend, and it has been falling. So overall bearish trend for Devon Energy continues. Only hope I can see is like it may be reaching the December lows. If it finds support around it, it could be a good place to accumulate the stock. EOG, on the other hand, it has fallen through its previous resistances and is in complete downtrend at this moment. Right now, only thing which could turn around is like if there's some new news. Otherwise, this downtrend could continue for foreseeable time. Noble Energy, as we discussed earlier, it has been trying to find a support. So there is a diamond pattern forming. The direction for resolution for such pattern will be very critical for the stock. If it goes up, then it's a really good stock to buy. So I'll be watching out for breaking this diamond pattern in the upper direction. If that happens, which stock already tried to do after August. In August, but it did not. It could not continue because of the overall weakness in the stock market. Otherwise, it's looking positive to me in terms of breakout, until the entire U.S. market resolves in a downtrend. I'm hoping the Noble Energy could turn around and pick up towards the positive direction. Schlumberger, again, this has also broken its support from last year, which is a bad news, and the fall should continue, and a lot of people have invested in Schlumberger and they're losing money. Williams company, again, it's toying around its upward trend, just like Noble Energy. So it has broken down the trend in the downward direction. It's trying to struggle to see if it can come back to its glory. If not, then the stock should fall below $21, in my opinion, in next 3 months or so. Let's look at the financials of these 5 stocks. Market cap wise, EOG is one of the bigger ones, and Schlumberger is the biggest in this industry. Top 5 stocks are listed here. Dividend yield wise, Schlumberger and WMB are giving more than 6%. So overall, pretty good dividend across the entire sector. In terms of return on assets, how well the management is utilizing its assets, Noble Energy was a concern which we showed you earlier, and it's showing in the analyst ratings, and it's showing negative return on assets and negative return on equity, which is a concern. Current ratio for Noble Energy is also below 1, which shows that company is not able to pay its bills with the operating income or operating cash it is generating, which is considered not good from operations efficiency point of view. For WMB also, we see the same concern, where they are not able to meet their current obligations, and those should be the concern for these 2 stocks. A long-term debt to equity for Noble Energy is less than 1, which brings a sigh of relief, which makes it a better stock. But for WMP, it is higher than 1, which is company has more debt than the assets or equity it possesses. So which will be a concern for WMB. So overall, for WMB, I'll be very concerned about the long-term. They're not generating enough cash to pay their current bills, and their future bills are also looking pretty bad for the company. So overall, WMB could be a place where I will like to avoid, even though they are giving pretty good dividend. I think they should cut down their dividends and pay towards their current bills they have to pay. So this looks very silly to me, that the company is not able to pay their current obligations, but they want to pay out the investors to make them feel happy. Which is not a good strategy from management efficiency point of view. Schlumberger, on the other hand, they don't have too much debt, and they have pretty good current ratios, so their dividends could be justified. So if for dividend oriented investors, even though stock is falling, I could be leaning towards Schlumberger in that area. Here are some of the valuations for the 5 stocks we have been looking at. In terms of PE ratio, overall pretty decent PE ratios, except Noble Energy, which is running in losses, and WMB, which is struggling to improve its financial sheets. Forward PE wise, I think all the stocks look pretty decent. Again, Noble Energy is a concern from earnings point of view. Price to sales and PEG ratios are less than 1 for Devon Energy and EOG, making them the value play. Schlumberger has a decent PEG, not a bad choice. WMB definitely has much higher ratios because of the financials we discussed earlier. Price to sales, that also looks decent across the board. Price to book looks decent all across the board. Price to cash flow, again, Noble Energy is a concern because of negatives. So in terms of earnings per share for the next year, the analysts are expecting the Noble Energy to start generating some positive earnings next year, even though it's going to be a small amount. In terms of the EPS for next year, I think EOG looks pretty decent from next year's earning growth point of view. So does the WMB. For EPS growth for next 5 years, Noble Energy should continue to grow better than some of them. Devon Energy and Schlumberger and EOG, all of them have pretty good EPS growth for next 5 years.
This chart shows the natural gas consumption by sector, and this chart is from 2018 when US consumed 30 trillion cubic feet of natural gas. The biggest consumption was by electric power, 35%. Next was from industrial, 34%, residential, 17%, commercial, 12%, transportation, 3%. Some of the salient observations: US has been moving their electric power generation to natural gas-based plants, which has helped increase the demand of natural gas in the sector. Industrial, residential, and commercial, sometimes these are cyclical sectors in terms of natural gas consumption. That is, for example, in the houses, people use gas-based furnaces which are used to warm your houses. So years when you have really bitter winters with low temperatures, those are the years the gas consumption goes high. Same goes for commercial buildings also. For HVACs, the natural gas main usage is to keep the buildings warm, right? So these sectors sometimes are cyclical and dependent on the environment. A lot of other sectors, consumption is based on the demand, global economic situations, and so on. Another comment I will make is transportation is only 3%, and there should be a push in the United States to convert a lot of its vehicles to natural gas-based vehicles. So that will help the environment, as well as it will help increase the consumption of natural gas. Looking at a long-term consumption chart for natural gas, this chart shows from 1950 to 2018. So that is covering over, like 50 plus 18, 68 years of consumption charts. Here, the green line is showing the residential consumption. As you can see, from 1950s to 1970s, there was big innovation into how the homes are built, how the people moved from oil to natural gas for their heating of their houses and so on. And a lot of our appliances such as ovens were moved to natural gas. So that was the period where we saw a lot of increase in the demand for natural gas. But surprisingly, from 1970 to 2018, which is like almost 50 years, the demand for natural gas has remained very, very stagnant. It has slightly gone down with all the population increase and different type of energy sources such as solar. These demands have been offsetted with other sources of supply, and this trend has remained slightly negative to stable. Right. Next, consumption is a commercial, where we saw similar demand, and surprisingly, commercial usage also has remained stable, even though we have a lot more buildings, large buildings, and part of it is again alternative sources for energy which are utilized for these buildings. Next is industrial. Industrial has saw a big boom in the consumption of gasoline, natural gas, but since 1970s it has been vacillating. There have been years of steep declines, again and then rise again till 2000, and then decline and rise again. So some of these cycles which were seen in the industrial sector, they are due to again geopolitical factors of what kind of subsidies could be provided to industries, what the environment policies come into picture, political parties, they try to influence some of these decisions. Next sector is electric power. As we talked earlier, it is a growing area for consumption of natural gas, and as a lot of our electric power generation is moving to natural gas based turbines and sources. And the last sector is transportation. Transportation has remained really small sector, and that's one area where I will personally say that US government should move a lot of their vehicles to natural gas. Now looking at from demand side, when we look at the production side, from 1900s, this chart shows from 1900s to 2020. As you can see, there was a huge
a production growth from 1900s to 1970s, but just because of the consumption saw a stall back in 1970s, so did the production. Production vacillated, falling all the way till 1985. Then they had a long period of increase for 15 years. And then fracking was invented, and then recently US has been one of the world's largest producer of natural gas, and the trend is growing where a lot of industrial innovations are helping to reduce the production costs as well. And US is to a point where US can be the biggest supplier of natural gas to other countries also, and there has been a big political push to encourage that. Looking at the 5-year charts, again, natural gas prices have been extremely volatile. They swing almost 50% in a year, 50% or more. So they fall 50% and recover more than 50%, going all the way to giving you almost 100% return. So if somebody could play in natural gas, they can pocket a pretty good amount of money if they are shrewd traders. But a lot of the investors who invest in mutual funds, they don't like to speculate too much, and they don't like to be in and out of trading vehicles very often. So as a trading vehicle, it may not work, but it's good to know the performance over last 5 years. So usually, as you can see, there is a cycle. You can pretty much see a cycle going on, and my estimate is about 2-year cycle of 2 years of rise and 2 years of fall for these periods. So if you look at it, like it started way back in 2014, it fell for almost like 1.5 years, 2 years, and then it rose from March 2016 to December 2017, and then it fell till next December, and then rose and fall. So this has been going on in cycles for almost 5 years, and that range could be extended to further 10 years. And in 10 years, you will still continue to see those cycles which I talked about, where natural gas prices rise, fall, rise, fall, rise, fall. So in last 10 years, the highest price it has touched is $6, and the lowest it has touched is $1.74, which was seen way back in February 2016. So we will expect that coming this winter, the prices should fluctuate, and we always hope the prices go up, but you can't tell that with the confidence that if the prices will rise or fall. The prices depend on a lot of geopolitical factors as well as the demand and supply for natural gas. Let's look at the natural gas prices over the past year. So last summer or last August, the prices were $2.94, and today in August 2019, the prices are $2.20. During this entire year, prices fluctuated a lot. They went up from $2.98 to all the way peaking in November with a 64% gain to $4.84. But since November-December time frame, natural gas prices have plummeted pretty hard, falling almost from peak to bottom. It's a pretty steep decline. It's cutting down almost 1/3 or more than half of the value. And then within the year, it tried to rally a few times, as you can see, but all the patterns are showing a lower low and lower highs throughout the year. Now let's look at the really long-term chart of natural gas. This chart goes all the way to 1990s and coming to the more recent times. In 1990s also the prices were hovering between $1.55 to $2 range, and that trend remained in place for good 10 years. For 10 years the price was stuck into this small trading range. So historically natural gas prices were low, and they remained there low for very long periods of time. So just like any other commodity, like for example, if you have gold bug or if you have studied gold, you will see similar trends where commodity prices sometimes they get stuck into a range for very, very long extended periods of time. Sometimes it could be tens of years, 15 years, 20 years, that kind of big range. So you have to be really, really patient with these kind of commodity investments. Then in 2000s, the early 2000s, natural gas prices saw a huge spike in the prices. This is the time when dot-com bust happened, and then discussions about some of the geopolitical Middle East things happened, and US got involved into fracking industry. So a lot of those innovations happened. During that time, a lot of investors who didn't know about natural gas, just like me, I will accept it. I got stuck into this hype. So during this period, a lot of people, new investors came in, they got in, and prices kept going up, touching all the way to more than $13. So the highest it just touched from $15 to $13, the 10x increase over almost 15-20 years, and since then it has been falling. So it's a big fall for some of the investors who might have bought at the peak, and they're still seeing the fall and licking their wounds. Let's look at the correlation of Fidelity Select Natural Gas Mutual Fund with some of the key benchmarks I picked. One of the benchmarks I picked is S&P 500 index, which is for that I picked Vanguard 500 index. If you look at FSNGX, it's weakly correlated positively correlated with the S&P 500. Second index I picked is international markets, all the stocks outside US. So for that I used Vanguard International Explorer Fund. So there also it's a very similar correlation so 2-year correlation is 0.62. And then I also try to pick US commodity index, USCI. For that also FSNGX shows a positive correlation, but very weak one. So overall, one would have expected the commodity prices will be strongly correlated with FSNGX, but the answer comes out is no, that's not the case. And it is almost a similar correlation as the stock market. Others might have thought like, hey, it should be tightly correlated with the stock market performance. The answer is again no, that's not the case. So looking at last 9 years, the Fidelity Select Natural Gas has behaved like an independent asset class with weak correlation to stock market as well as the commodity index. Looking at about 1-year return from August last year to August 2018 to August 2019, the FSNGX is shown in this magenta line, where it was stable from summer to almost winter time, and then winter time mutual fund saw a steep decline and till December, falling almost 35% in short 1 quarter. And then from January, mutual fund tried to recover half of its losses, and then again in summer this year, starting May, there has been a swoon of fall for the mutual fund. So overall, based on how the winter looks like in terms of demand, we may start to see some recovery. So at this point, the low we have hit is lower than what we saw in December. So this is a matter of concern where it could be pointing towards a longer term decline. Comparing it to S&P, which is shown in red, you can see there's a huge performance gap. Despite all the swings we have seen in S&P 500 for last year, overall performance by ups and downs is just 3 to 4% for the entire year, whereas FSNGX has lost 36%. So delta is pretty big. So some of the contrarian investors, they could look into pulling some money out of S&P and investing into FSNGX for 2 reasons. One is contrarian play, like this has fallen, and by the law of averages, at some point these gaps should reduce and recover. Here is the long-term performance of FSNGX. The mutual fund has been around since 1994. Overall, over all these years, the mutual fund has given 5% return. From 1994 to 2008, when a lot of people started paying attention to energy sector, the mutual fund had a tremendous long-term record of returns. But then after 2008 collapse, the mutual fund fell very, very sharply, losing more than 65-66% of its value. And it tried to recover from 2009 to 2014. But then again, in 2014, the mutual fund saw a steep decline, bringing them down to almost the same low levels as seen in December 2008. Since then, the FSNGX has been trying to go sideways. It tried to do a couple of recovery rallies in between. And so overall, for really long-term mutual fund holders, it has been a very, very dismal performance. I will admit that I got sucked into this mutual fund way back in 2008, before that hype, and I have been holding my empty bags for a very long time. From time to time, I have tried to recover some of the money through ECA, where I buy at lows and try to sell them at highs. But that micro timing really doesn't work very efficiently because even though I may claim that hindsight is 20/20 and I could have done much better, but when you try to implement some strategies, they always have challenges. Of course, I have not done as bad as if I would have just held the mutual fund. Because of my active nature, I have been able to recover some of my money through these run-ups, which we see every year. So we'll talk about those strategies in a later part of this video. But overall, I just wanted to show a really long-term performance record of this mutual fund. Let's look at the technical analysis of Fidelity Select Natural Gas. For last 5 years, as we have been talking about, the mutual fund has been in a persistent downtrend. It's mainly because of the natural gas stocks in general. For last 5 years or even longer, since pretty much 2008, this sector has been in a persistent downtrend and a bearish trend, which has lasted for over 11 years now. So let's look at about last 5 years what happened. Initially, it has been falling. It fell till 2016 December, and then in 2017 early on there was a big rally. So throughout 2017, FSNGX gave pretty good return, going from $15 to almost $30. So it's close to 80-90% return in that period. But since then, 2017, again it started its downtrend. So if you look at, if you focus on time period from 2017 to now, which is August 2019, you can see that it has pretty much followed the Fibonacci series support and resistance levels. So it fell from $29 to around 2038. And it has been bouncing around those Fibonacci series. If I draw this resistance line, it's in downtrend. You can see the FSNGX tried to break through it in the summer of 2018, but then it failed. And if you look at the accumulation distribution MACD, that would have told you the story back in 2018, even though the charts were showing that there's some amount of accumulation could be going on, but actually there was distribution going on where people were trying to dump the mutual fund, and there was a downtrend. And since then, RSI was also falling during that time. And since then, when another down wave came, it was very, very steep. So back then, FSNG fell from around 2565 all the way down to 1683. So that was a steep decline seen from October of 2018 to December of 2019. And then from January till April, again there was a bounce back from 1683 to this 50% retracement level to 2246, and then we have again taken a downtrend. So at this moment I'm expecting the downtrend to continue till it sees the support of 1512. So anything below 1550 will be a good accumulation point. So I myself am going to start accumulating around 1550, and I will be doing dollar cost averaging for my holdings, so that whenever a bounce back comes, I can get rid of some of my better performing lots and try to bring down my average cost of this long-term holding I have. So overall, things have been in downtrend, and we are approaching, for those patient investors who are waiting for this downtrend to eventually end, we might be nearing that. So I will expect that this winter we should see a bounce back, so I will assume that this summer time, August, September, October, these should be good accumulation period, and after that we should see some bounce back, maybe this winter, or at least by the next June. So I will assume that my personal plan is going to be that accumulate for at least 3 months starting August, and then watch it for October, November, December. So if till December, if it keeps falling, I will be doing more accumulation, so that next year from January to maybe summertime, I should see some bounce back where I can recover some of my money. Thank you.